Today, we're going to go ahead now and look at our second section of Chapter 2, which is dealing with three different types of businesses. There's three different types of businesses that main types of businesses. And different types of businesses are going to use different financial statement layouts. They all show the same kind of information. It's just that the way that the information is laid out might be different. And so, for example, a small consulting firm, they would use a very simple income statement and balance sheet compared to a complex manufacturing company that produces goods. The manufacturing company requires a lot of a more detailed set of financial statements, so different areas on the financial statements that provide information to the manager to know how to operate the business efficiently. And there are the three different main types of businesses. We have service businesses, we have merchandising businesses, and we have manufacturing businesses. And we'll talk a little bit about each and how their balance sheet and the income statement, how it's structured. So we see that a service business is going to be a commercial enterprise that provides work that is performed in an expert manner by an individual or team for the benefit of its customers. And so examples might be accounting or law, consulting, lawn service, contracting, haircut, auto mechanic, anything like that would be considered a service type business. And some accounts that would be specific to that on our income statement, they will have a cost of sales account, which shows the area which are the expenses that are directly tied to the service revenue that's earned, such as the salary of the consultant. All right. They would have gross profit, which would be the difference between the service revenue and the cost of sales. And then that is what's used to pay for the other expenses that they have. And then for the income statement, they would also have operating expenses or overhead. That's the day-to-day cost of running the business. So operating expenses might be their PG&E, so their utilities, rent, anything that doesn't directly relate to providing the actual service, but it's things that they need. And then on our balance sheet, we would have an account called work in progress. That's an asset that represents jobs that are currently being worked on but are not yet complete. And the reason for that is, we just keep it in there as an asset. Now, another type of business, of course, is a merchandising business. That is a business that buys goods in order that they would resell to customers. And examples of retail, of course, are Target, Home Depot, Walmart, anything like that they buy products that are already assembled and then they sell them to customers. New accounts specific to them that they would have, a merchandising miser would be on their balance sheet. They would have an account called merchandise inventory, which is an asset that represents the value of all of the goods that the business has purchased and intends to sell to its customers. So anything that they have in inventory would be listed under the merchandise inventory. And then on the income statement, we have what is called cost of goods sold, which is the value of all of the goods that have been sold. That gets subtracted from our sales revenue in order to determine the gross profit, which then the gross profit part of it then is used to cover all of our other operating expenses, and then we would get our net income or net loss, what we have left over. And then, of course, the manufacturer business is one that they actually make the products that they sell. An example would be automakers, Ford, GM, Toyota, they build the cars that they sell. A steel mill, maybe a furniture company. So they make things then that they sell. Okay. And in some accounts specific to a manufacturing company, on the balance sheet, we would have an inventory for the raw materials. That is for the manufacturing of products that's sold. So, for example, uh, I'm just looking at it because I have to put it together. It's still in the box, but I bought me a new desk to set my computer up on. Um, and raw materials might be the wood that's used, might be the metal that's used, the steel parts that are used for it, um, so on and so forth. So those would be the raw materials. Now, the work in progress is another one. So we'd have inventory work in progress. That's for partially completed products. So it's possible maybe at the end of the month or the end of the quarter or the end of the year, we have products that are not completely finished yet, but we have to account for those because obviously then that value of that then is going to go into that next accounting period. So that would be considered work in progress. And then we have finished inventory, finished goods, which are goods that can then are finished and ready to be sold. So for example, this desk, once it's all put together, all the parts are made, everything's put together in the box, it's finished goods, it's sitting in the warehouse until it's purchased. And then once it's purchased, then we would ship it out then to our customer. And once we ship it out, then it would be considered then cost of goods sold, which is the value of all of the finished goods that have been sold. And that goes on our income statement. So which type of business is going to be more likely to have raw materials inventory? Is it going to be a service business, a manufacturing business, a merchandising business, or all of these? And it's going to be a manufacturing business. Now, a service business, they would have things that they might need. For example, if maybe they're a cleaning company, all of the cleaning supplies, all of the cleaning chemicals, all of those kinds of things. But that would be more or less kind of considered an overhead item for, let's say, a janitorial company, because they're not going to be able to tell exactly how much gets used up in each job. But a manufacturing business, obviously, they're going to have, if it's like a furniture company, they're going to have wood, all of the metal parts, all of the cloth fabric, if they're making chairs or different things. So all of that is raw materials. Okay. Now, if the income statement of a company does not have a cost of goods sold as its line item, what type of company is it likely to be? Either a service business, a manufacturing business, or a merchandising business. And it would be a service business because it's not going to be cost of goods sold. It's going to be called cost of sales is the account that they would use.